We are going to discuss a guide for cryptocurrency tax rules, and these are lessons for all Bitcoin or crypto investors to help create the best system as possible. How many Bitcoin investors are not up to speed with the IRS crackdowns in recent history? Probably many. Coinbase has 35 million customer accounts, and the number of taxpayers reporting crypto trades was until recently in the hundreds. If it was once hard to plead ignorance of tax laws regarding crypto, it's now impossible. The new Form 1040 demands that taxpayers say whether or not they own any virtual currencies. And the yes-no question parallels the one that was implemented years ago in offshore investment accounts and led to nasty treatment of people who lied. Number one is crypto property. Bitcoin and its competitors look a lot like money. They're a store of value and a means of exchange. But the IRS has decreed that these assets are not currency and not securities either. They are property, more like a shopping mall than like $100 bill. As capital assets, they give rise to capital gains and losses when disposed of. A profit is taxable at a short-term gain if a position has been held for a year or less, as long-term if held for more than a year. And if a coin is held for profit rather than amusement, which is presumably almost always the case, then a loss on it is a deductible capital loss. In computing a gain or loss, you use as your starting point the basis of an asset, tax lingo for your original purchase price, after occasionally some adjustments. 2. Sales are not the only form of taxable transaction. You have to report the disposition of a virtual currency if it is 1. Sold for cash, 2. Traded for another crypto, or 3. Used to buy something. But merely transferring coins such as from a wallet to an exchange or vice versa is not a disposition, nor do investors who buy and hold owe a tax. 3. The tax code's wash-share rule does not apply. This rule forbids the claiming of a loss on sale of a security if you bought that security token within 30 days before or after. If, for example, you buy a Tesla share at $800, sell at $720, and buy it back quickly, the $80 loss is suspended. But Bitcoins and the like are not securities. They're pieces of quote-unquote property. So you can go out of the loss and then right back in without losing the right to immediately claim the loss. The next one, 4, is exchanges squeal. Coin exchanges based in the US file information returns on customers with a lot of trades. The 1099-K is mandatory for a customer who in one calendar year does at least 200 transactions with proceeds totaling at least $20,000. This is the same cutoff for other intermediaries handling property transactions such as eBay. The 1099-K form is like the 1099-B that stockbrokers file, except that the latter form does not have the 200 trade minimum, and the K probably won't tell you what your cost basis was for a coin. As with 1099-Bs, so with the Ks, the fact that you did not get the form because you didn't do a lot of trading or any other reason does not absolve you of the obligation to report all sales and other dispositions. Number 5 is forks can create ordinary income. When a share of stock splits in two, by and large, there's no taxable transaction. Its purchase price gets carved up and assigned to the two prices. You declare a sale on either of those pieces only when you dispose of it. If and when you do sell a piece at a gain, you'll get the favorable capital gain treatment. This is what would happen if one share of ExxonMobil split into one share of Exxon and one share of Mobil. The IRS has a different view of coin split-ups that occur when a blockchain forks into two chains. It thinks that the split creates a windfall equal to the starting value of the newly created coins, and that this windfall should be taxed at high ordinary income rates. This is what happened when Bitcoin spun off Bitcoin Cash in 2017. Each old Bitcoin coin continued to live on one chain, while one newly created BCH on a new chain was dropped into the lap of the Bitcoin owner. You are supposed to declare the BCH as ordinary income. It's a good bet that many coin holders neglected to do so. How does the tax agency justify its rule? With some very strange logic, it sees a coin split as less like an oil company splitting into then is like a taxpayer stumbling onto a $100 bill in the parking lot. The new currency created by a fork is income when you can get your hands on it. This is true even if you hold on to the new currency. The cost basis for the new coins is whatever you had to report as income. The next is airdrops create ordinary income. An airdrop is the random distribution of coins in the course of a marketing effort. The IRS has also used the term incorrectly to describe the spin-off explained in the previous section. With considerably more justification than it has taxing forks, the IRS considers marketing giveaways to be ordinary income. And you report the income from a marketing scheme as soon as you get the freebie. That reported income becomes the cost basis if you later dispose of the coins. The dollar amount will probably be small as people don't give away valuable coins. 7 is mining creates ordinary income. Suppose you join a mining pool and spend $8,000 on electricity and get rewarded with a Bitcoin worth $10,000. Even if you don't sell the coin, you have to report an $1,800 profit, and that profit is ordinary income. Your new possession has a basis of $9,800, and any gain or loss from that point is a capital gain or loss. That could create a painful result if the coin collapses in value to $8,000 and you sell it. You have broken even, but you'll probably owe tax. That's because you're combining $1,800 of ordinary income, taxed at a high rate, with $1,800 of capital loss, which may be worth considerably less than your tax return. The profit and loss described here applies if you're mining with the aim of making money. If in contrast the IRS can show that your mining is no more than a hobby, then you can get stuck with hobby accounting. That's a disaster. And hobbyists must report all their revenue as income, but cannot deduct any other costs. The next is staking gives rise to ordinary income. Some crypto chains like Tezos reward participants for putting up their coins as collateral and then certifying transactions. The reward coins are treated like bank interest as ordinary income. Some exchanges handle the work for you and then split the revenue. In that case, your income is your share of the fee, not the gross amount. The next is gifts of crypto to charity get treated like gifts of stock up to a point. Buy coin at $4,000, wait more than a year, and donate when it's worth $9,000, and you get a $9,000 deduction without having to pay tax on the $5,000 gain. But gifts of property as opposed to securities worth more than $5,000 need appraisals, so this can get messy. If you donate an appreciated property after holding it for less than a year, your deduction is limited to your cost basis. But what about the depreciated property? Do not give it away. Sell it and take the capital loss. The next is gifts of crypto to friends and relatives are treated like gifts of stock. A donee's cost basis and holding price are the same as if you still held the coins, but with one small distinction. If the property has fallen in value during your ownership, then a special rule comes into play. Say you bought a Bitcoin at $12,000 and give it to your niece when it's worth $11,000. If she sells that more than $12,000, then she uses $12,000 as her basis. If she sells that less than $11,000, she has to use $11,000 as her basis, reducing the capital loss that she can claim. Any sale between $11,000 and $12,000 is in a dead zone that creates neither a gain nor a loss. The next is like-kind tax postponement does not work. With the like-kind rule, people aim to treat the exchange of one crypto for another as a non-taxable event, postponing tax until sale of the new coin. It probably did not work for tax years before 2018 because coin exchanges did not meet the exacting requirements for like-kind intermediaries. It definitely does not work for 2018 and later years because a new statute limits the like-kind treatment to real estate swaps. The next is Bitcoin futures are Section 1256 contracts. Futures on Bitcoin traded on the Chicago Mercantile Exchange get the peculiar tax treatment of commodity futures. Positions are marked to market on December 31st with paper gains and losses recognized as if the future position was sold and immediately bought back. And B, the gains and losses are assumed to be 60% long-term and 40% short-term, no matter how long the position has been held. The next is crypto is probably subject to the straddle rule. This rule forbids you to deduct a loss on closing a position in an actively traded investment. stock, option, whatever, while you maintain an open position that runs in the opposite direction. Thus, if you own an S&P 500 fund while simultaneously holding a short position in S&P 500 futures, you cannot sell just one of these to claim a capital loss while still holding the offsetting position. You could run into a problem here if you have multiple positions in Bitcoin futures, or Bitcoin options. The next is offshore crypto is probably not subject to FBAR and FATCA reporting. These two regulatory regimes compel you to disclose cash and securities held in offshore accounts. They do not, however, apply to property that is not cash or securities. So your Bitcoin account at Multibase Binance is not covered by these rules. Some lawyers advise you to file the reports anyway. If you trade during the year into conventional currencies like dollars or euros, you might cross the threshold and be required to file. The labor cost of filing is small, but the penalties for not complying are severe. The FBAR, or Financial Bank and Financial Account form, which kicks in if an offshore account tops $10,000 at any point during the year, must be filed electronically. The FATCA, Foreign Account Tax Compliant Act, has different thresholds that start at $50,000. The form number 893 can be filed in paper. And you do not need to file these reports for assets held at a U.S. regulated exchange like Coinbase. Exemption from account disclosure does not confer an exemption for the rule mandating the reporting of any sale at a gain. If you have a profit from crypto, even $1, then it has to go onto your tax return no matter where the coin is held. The next is identifying law works as it does with security. Say you bought 5 Bitcoins at $6,000 and 5 more at $8,000. Now you sell one coin for $9,000. Was it one of the early ones creating a $3,000 gain, or one of the late ones a $2,000 gain? The IRS gives you two choices. The default choice is first in and first out. In a rising market, that tends to give you high tax bills. The second choice is specific identification. You maintain meticulous records enabling you to spell out which coin was sold. This enables you to make a selection that minimizes your tax bill, usually the coin with the highest purchase price. It helps you to have a coin tracking service handle this dirty work.